Stop losses are widely regarded as a protective mechanism, but under extreme market conditions, they can paradoxically exacerbate portfolio losses. This is the central paradox of risk management. The tool designed to limit damage can become the source of further destruction. Conventional financial education often emphasizes that setting a stop loss is a hallmark of disciplined trading. The concept is straightforward. You predetermine the maximum loss you are willing to accept on a position and place an order to exit automatically if the price falls to that threshold. This approach is intended to remove emotional decision-making, enforce consistency, and protect capital from adverse moves. In normal market conditions, this strategy works reasonably well. However, the conventional wisdom overlooks a critical detail: stop losses are not executed in a vacuum. They are executed in real markets with real liquidity constraints. During periods of stress, liquidity can evaporate precisely when you need it most. This means that the execution price of a stop-loss order can deviate significantly from the intended stop price, leading to larger losses than anticipated. The assumption that stop losses provide reliable protection fails to account for market dynamics under duress. The core problem with stop losses in volatile markets is slippage. When a market is in freefall, there may be no buyers at your specified stop price. Your order will be filled at the next available price, which could be substantially lower. This is particularly true if you use a market order, which guarantees execution but not price. In a panic, the order book thins out, and your stop loss can be triggered at a price far below your intended level. The result is that you lock in a loss that is much larger than you planned. Instead of protecting you, the stop loss amplifies your loss because you are selling into a vacuum of liquidity. This mechanism explains why stop losses can be counterproductive during market crashes, turning a manageable drawdown into a permanent loss. To formalize the slippage problem, consider the actual loss you realize. It is not just the distance from your entry price to your stop price, it is that distance plus slippage, which is the difference between your stop price and the actual fill price. In a liquid market, slippage is minimal, but in a crash, it can be substantial. The total loss per share is the entry price minus the fill price. Since the fill price is the stop price minus slippage, the total loss equals the planned loss plus slippage. This simple identity demonstrates why stop losses can be dangerous in volatile conditions. The very mechanism intended to limit losses can, through slippage, increase them. Understanding this relationship is essential for evaluating the effectiveness of stop-loss orders in risk management. AQR research has examined the performance of stop losses during extreme market events. In the 1987 crash, the 2008 financial crisis, and the 2020 pandemic sell-off, investors with strict stop losses often got stopped out near the bottom. They sold at the worst possible time, locking in losses, and then missed the sharp rebounds that followed. The evidence suggests that stop losses do not protect you from tail risk, they convert temporary drawdowns into permanent losses. The very mechanism designed to limit damage becomes the source of permanent capital destruction. This historical pattern underscores the importance of understanding the limitations of stop losses and the need for a more nuanced approach to risk management. Here is the counterintuitive part: for many long-term strategies, the biggest risk is not the absence of a stop loss, but setting it too early. Consider value investing. You buy undervalued assets, and as they get cheaper, you buy more. A stop loss would force you to sell exactly when the opportunity is greatest. Trend following is similar. You enter after a trend is confirmed, but you must tolerate drawdowns along the way. The success of these strategies depends on enduring short-term pain. If you stop out too early, you miss the eventual recovery. This paradox highlights that stop losses can undermine the very logic of certain investment approaches, making them counterproductive for long-term investors who rely on mean reversion or trend persistence. Let's compare value investing and trend following. Value investing seeks to buy assets below their intrinsic value. It expects price to revert to that value, so it tolerates drawdowns and often adds to positions as prices fall. Trend following, on the other hand, rides established trends and uses trailing stops to protect gains, but it still accepts significant drawdowns as the cost of capturing big moves. Both strategies require a high tolerance for short-term losses. A premature stop loss undermines the very logic of these approaches. For value investors, a stop loss would force them to sell when prices are most attractive, defeating the purpose of buying undervalued assets. For trend followers, a stop loss set too tightly would exit positions during normal pullbacks, missing the larger trend. Thus, the appropriate use of stop losses varies by strategy, and a one-size-fits-all approach is flawed. So what is the right way to use a stop loss? The answer is that a stop loss should not be designed to prevent losses, it should be designed to prevent catastrophic losses. That is, losses that would permanently impair your capital. For normal volatility, you should not be stopping out. Instead, you should be checking your position size. If a drawdown is too painful to tolerate, the problem is not the lack of a stop loss, it is that your position is too large. Position sizing is the first line of defense, not the stop loss order. By adjusting position size to match your risk tolerance, you can withstand normal drawdowns without being forced to sell at inopportune times. A stop loss should only be used to protect against tail risks, not to avoid routine market fluctuations. The key to risk management is position sizing. The dollar risk of a position is the number of shares times the difference between your entry price and your stop price. To keep that risk within your tolerance, you adjust the number of shares. For example, if you have a $100,000 portfolio and you want to risk 1% on a trade, your maximum dollar risk is $1,000. If your stop is $5 away from entry, you can buy 200 shares. This formula ensures that a stop loss is just a tool for defining risk, not a reaction to fear. By sizing positions appropriately, you can ensure that a stop loss, if triggered, results in a loss that is acceptable relative to your portfolio. This approach shifts the focus from setting stop losses to managing exposure, which is more effective in volatile markets. To manage risk properly, you need to track a few key metrics. Maximum drawdown measures the largest peak-to-trough decline in your portfolio. The Calmar Ratio divides annualized return by maximum drawdown, giving you a sense of return per unit of pain. Volatility, often measured by standard deviation, tells you how much your returns fluctuate. These metrics help you understand whether your strategy can survive the inevitable drawdowns without forcing you to stop out at the worst time. By monitoring these metrics, you can assess the riskiness of your strategy and make informed decisions about position sizing and stop-loss placement. Without this quantitative understanding, you may be relying on intuition, which can lead to poor decisions during market stress. The Calmar Ratio is a useful tool for evaluating a strategy's risk-adjusted performance. It is calculated as the annualized return divided by the maximum drawdown. A higher Calmar Ratio means you are getting more return for the drawdown you have to endure. This is directly relevant to the stop-loss debate because it forces you to think about whether your strategy's drawdowns are worth the returns. If a strategy has a low Calmar Ratio, it may not be worth the pain, and you might consider a different approach rather than just setting a tighter stop-loss. The Calmar Ratio provides a quantitative basis for comparing strategies and understanding the trade-off between risk and return. It encourages a focus on the overall risk profile rather than on isolated stop-loss levels. So what should you do? First, recognize that stop-losses are not a universal safety net. They are a tool for specific situations. Second, focus on position sizing before you think about stop-losses. If a position is too large, no stop-loss will save you. Third, differentiate between normal drawdowns and tail risks. Normal drawdowns are part of the game, tail risks are rare but catastrophic. Your stop-loss should be set to protect against tail risks, not to avoid normal volatility. Finally, understand your strategy. If you are a value investor, a stop-loss may be counterproductive. If you are a trend follower, a trailing stop may be appropriate. The key is to align your risk management with your strategy's logic. By following these principles, you can use stop losses effectively without falling into the trap of amplifying losses during market crashes. The bottom line is that stop losses are not a magic bullet. They can protect you from catastrophic losses, but they can also amplify losses in a liquidity crisis. The key is to use them correctly, set them to prevent permanent capital destruction, not to avoid normal volatility. And always remember that position sizing is the first line of defense. By focusing on position sizing and understanding the limitations of stop losses, you can navigate volatile markets more effectively. Your feedback helps us create content that matters. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.